Vetri Subramaniam, Chief Investment Officer, joins us now. He represents UTIMC. Vetri, good morning. Thank you for joining us. Let me start with a very basic question. How would you assess the market right now? We've seen a great and a grand rally in 2023, but we've seen a mid-air turbulence in 2024. Do you think the excesses in the market have been weeded out?
Yeah, good morning, Nikunj. Glad to be here. Well, I wouldn't really say the excesses have completely been taken out of the market. To be very fair, if you look at the large caps, the valuations are punchy, but I'd still say they're not sort of blinking red. But the mid cap and small cap segment of the market, I would say the valuations there still give us cause for concern. There is really no margin of safety over there. They are in fact trading at a premium to the large caps, which is not something I have typically experienced, in my 30-year career. The mid caps sometimes do trade at a premium to large caps, but very unusual for small caps in aggregate to trade at a premium, which they are, which is why, to my mind, the valuation comfort there. I know they've corrected a little bit more from the top as compared to the large caps, but still no margin of comfort, so to speak.
Is that happening largely because the nature of the economy is changing? Suddenly there are a lot of niche companies, new companies, which are in a sense are the new high growth companies, whether it is in defense, energy, food delivery. I mean, these businesses never existed. And these are the new businesses which are growing at higher run rates. So markets are giving them a premium.
One way to look at it, but I always look back at a wonderful question which Jeff Bezos once asked. And he said that people ask me what will change in the next 10 years. And I prefer to tell them what will not change in the next 10 years and anchor myself to that. And I'll tell you what will not change in the next 10 years. What will not change is that there will be macroeconomic cycles. Interest rates are going to go up and down. There will be regulatory changes. There will be winds of change. There will be disruptions that happen. And we know from history that, in fact, it's the smaller companies which tend to be at the receiving end of these changes, whether these changes are in terms of regulations, they are in changes in terms of the cost of capital, they are changes. And smaller companies also struggle to deal with some of these disruptions and changes because they typically lack the kind of management depth, they lack management breadth, and they don't have access to technology and capital that their larger brethren have. So if you ask me, that's going to change. Of course it will. Change always happens. But I will also tell you what doesn't change. And these are the things that don't change. And that is why typically I would argue that as an aggregate, the large caps typically are better placed to deal with these changes than other small caps.
But for markets to go down in a significant manner, barring a mid-air turbulence, what we saw in mid-March, what could be the reason? Could it be valuations? Could it be macro? Could it be global factors? What will drive the markets significantly lower from here?
Nikunj, I have a lot of gray hair. I don't see too much gray hair on you, but I know you're closer to me in age than to being a young Turk on the street. Look, you never know these reasons beforehand. So this is a futile discussion saying what will cause it to go down. We could have had this discussion in April of 2020, and I suspect if we look back through the archives, you'll see me talking to you sometime then. And we would have said, look, valuations are cheap. That's all we need to know. And you would have said, what will cause it to go up? Now, who the hell knew that, the wonders of modern science, people putting their effort to it, we would get vaccines, we would re-engage with the world, we would emerge so much stronger. And believe it or not, we would get a 70% pop in Nifty 50 profits over the next 3 years. Unbelievable going into the pandemic, being locked up at home at this point of time 3 or 4 years ago, that such a thing could have even happened, but it did. So the point I'm making is that you don't always know what is going to happen. So this is a very futile question to say, what is it that will happen? We don't know. And that's my simple answer.
But Vetri, what you do definitely know or seem to be knowing is that large caps are better placed versus small and mid caps, right? But again, within large caps, is it more of the same which is going to do well, or should one now look at bottom-up stories? Many peg as large cap private banks to be the pocket within large caps right now.
Yeah, sure. If you look at the large cap space, again, of the valuations, when you look at aggregates, will always give you a different picture. But if I were to point to one segment, and that's actually very significantly dominates the large cap space, it would actually be the banking and financial services space. Large parts of that have significantly underperformed. I would say, in fact, many of the large banks have significantly underperformed. And I actually think it's a fantastic opportunity over there. Now, I know people will tell me, oh, credit growth is too hot. RBI is trying to slow it down. Margins are going to be tight. Hey, but that's why you're getting it at the valuations that you're getting today. I have not seen India grow at any point of time without credit growing faster than GDP. These are the best balance sheets that some of the best run banks in our country have had in many, many years. The valuations are extremely attractive. And I would be very surprised if this sector doesn't punch its way through the next 2 to 3 years and participate in the growth that the economy is likely to experience. And remember, credit to GDP in India still remains very, very low compared to any comparison you want to make. So, to my mind, the large banks, which are pretty much part of significant weight in the Nifty, along with some of the other financial services play, that would really be my sort of number one pick if I looked at it bottom up in terms of what is it in large cap, which looks attractive. The second one, where valuation comfort has eroded because the sector has done well over the last 1 year, which is the pharmaceutical and healthcare space. But I still have some sort of positivity in that area, because what I'm seeing is that the companies are able to currently benefit from some of the growth trends in the local Indian market. And at the same time, I think a lot of their international operations are running slightly more stable in terms of their profitability. The worst of the pricing cycle is now behind us. So pharmaceutical healthcare is another area. Again, here, of course, it's a combination of large and mid cap, but that's another sector, so to speak, that I think, bottom up I like.
And similarly, what according to you is looking priced to perfection and thereby, scope for disappointment if they don't match with the earnings or the numbers? I mean, for instance, the auto names. I mean, who would have thought that M&M and Tata Motors are not going to match up to what the street was anticipating in terms of their March sales?
Sure. Good question, Aisha. We loved the automobile sector in 2022. It was one of the few areas where volumes in the sector were running 20 to 25% below the previous peak, and their previous peak happened in 2018. Now, this year, large segments of auto have finally pierced through the levels of 2018 volumes. Not to say that they cannot continue to grow, but I think a large part of the story in terms of the valuation re-rating, in terms of an improvement in margins because of operating leverage, a lot of that is done and dusted. So we're still positive on the auto cycle, but it's no longer something which really gets us excited, because both operating leverage, margin improvement, and re-rating have all sort of played out. So the number of legs it has to sort of support itself are now quite limited. Another area where I am cautious, may not be consensus view in the market, is really the whole capital goods space. To my mind, private capex and in general capex is still not in a very strong place. You only have to refer to some of the comments that the chief economic advisor also made recently at a large event, where he talked about the fact that the private sector is yet to come ahead. But I actually find a lot of the stocks in capital goods are now priced to perfection in terms of a strong industrial upcycle. I don't know, first of all, how high the probability that that will happen is. And even if it does, the valuations, to my mind, have removed a lot of the potential upside from those stocks.
Every market cycle follows a particular style. Sometimes value does well, sometimes growth does well, sometimes dividend does well. So for next 3 to 5 years, what kind of style are we in? Because post-COVID, first it was growth, then it was value. Now everything is khichdi. What would you bet on as a style for next 3 years?
That's a good question, Nikunj. But two ways to look at it. One is, I would actually say this is a time where you should actually think more about asset allocation. You should think more about risk, then you should think about upside. Very simple reason for it, that 3-year, 5-year returns across equities are very strong compared to the median sort of outcomes you would expect over a 3 to 5-year period.
Yep. I think
Significant amount of the upside has been driven than by earnings. So in general, we would say look more towards asset allocation products at this point of time. That's point number one. The second thing that I would really say is, when you talk about that classic value and growth cycle, when I look at a lot of the constituents of the value cycle, I would say they still may look cheap relative to some components of growth, but relative to their own history, their own capability of producing a high return on capital and being able to sustain the growth, I do think a lot of them are now starting to look fully priced. So there is very little sort of value, so to speak, left in that value style at this point of time. And if anything starts to, get a little bit shaky, I would submit that maybe growth actually has a little bit of an edge right now, simply because those companies tend to have much stronger balance sheets and cash flows.
If we were to, I know you're pretty bullish on the markets overall at the current juncture, talking about how the long-term story remains intact. But Vetri, I just want to understand, if there were to be any concerns emanating, do you think that would largely come from perhaps the global markets? Would it be a mix of domestic factors? What would potentially give you more gray hairs, if at all, or any concerns?
Well, thanks for that. But first of all, I should clarify, I'm very bullish on the country. I'm not so bullish on the stock market right now. Okay. And there's a very simple reason for that. The valuations don't give you margin of comfort, right? So look, if you're investing for 10 years, you're doing a SIP, keep going. There's nothing for you to sort of, back on. But I would actually urge people that given where we are in the valuation cycle, this is a good time to rebalance your portfolio. This is a good time to think more about risk from a rebalancing perspective rather than to think about upside. So, actually my view is not quite what you described. I think the country will do brilliantly over the next 10 years. Equity markets, I think, will find it a challenge simply because whatever our potential is has been significantly discounted into those valuations.
Vetri, so if the starting point, let's say 2nd of April, and thank God it's not 1st of April, otherwise, in hindsight, it would have been called the April's Fool kind of a question. If the starting point is today, and one has to, let's say, look at a 3-year out kind of a scenario for large cap equity diversified schemes. Historical average is 12 to 13% or 13 to 14%, whichever year you look at. Do you think for next 3 to 5 years, we are likely to give returns which would be above historical averages, in line with historical averages, or below historical averages?
This is a probability question, and there's no yes or no answer to anything. The long-term return is 12 to 13%, but you've got valuations at a point in time with trailing 3 to 5 year returns, which are much superior to what you would typically get. I would actually think at this point of time, the outcome is likely to be maybe, mid single digits, high single digits, rather than that 12 to 13%.
It's a great option right now. I mean, good quality corporate managed debt. It may sound boring. It may not sound extraordinary, brilliant if you talk about debt. It is early morning when markets have opened. But then go back to debt.
I think so. Debt is a good option. Now, one of the things I've experienced in the last year is that particularly among retail investors and HNIs, family offices, people have become very debt averse simply because of the change in taxation which happened in the mutual fund space last year. But I would actually say there are a wide range of hybrid products which still give you a taxation regime which is favorable without giving you full-on exposure to equities. So there are many of those products which, as you suggested, have significant debt sitting in them. It could be 70% debt, it could be 50% debt. And I think those are some of the asset allocation products people should consider if taxation is such a key consideration for them. But I'm completely with you on this. I actually think this is a reasonable and a good investment opportunity right now.
Okay, Vetri, thank you so much for taking time out and joining in. Good to have you on board as always and getting your take on the markets as well as individual sectors and the economy.
If you like this video, then like, share and subscribe to ET Now.